Assalamualaikum warahmatullahi wabarakatuh. So today we are going to present our group project for corporate finance MAF603. Case study number 1 will be presented by me, Nur Alis Aisyah, and next question will be presented by Nwani Shohada, and the last one is Nadira Yasmin. Okay, let's begin with the first question, which is calculate the earning per share for each alternative. Alternative 1, alternative 2, and also alternative 3. To get the EPS, we need to find the shares outstanding first, okay, which is the amount of equity divided by the price per share, which is for alternative 1 as example. Alternative 1, 350 divided by price per share, 2 ringgit and 50 cents, and the answer will get 140 for alternative 1, 120 for alternative 2, and the last one is 100 for alternative 3. Next, to get EPS, the amount of total earnings, okay, total earnings divided by the shares outstanding, we calculated just now, which is for alternative 1, due to no interest, so the amount of total earning is 200 million. So 200 million divided by 140 million shares, it will get 1 ringgit and 43 cents. For alternative 2, it's a bit different because for alternative 2, it has interest, which is 50 millions times with interest rate 10%. It will get 5 millions, and total earnings 200 million minus with 5 million, the answer we get 195 million. To get EPS, 195 million divided by 120 million, so the answer we get 1 ringgit and 63 cents. To calculate EPS for alternative 3, the working is the same like alternative 2 just now, which is the EBIT minus interest to get the total earnings, and total earnings divided by shares outstanding to get the EPS for alternative 3, which is the answer is 1 ringgit and 90 cents. So for the next question is, determine the distributions of income between the debt holders, shareholders, and the government for each alternative. As you can see here, for alternative 1, there is no distributions of income to bondholders because alternative 1 only finance with new equity, and also no apportion to government because no tax charge to the company. Next is for alternative 2, it is financed using 50% debt and 15% equity. So the total earnings, 195 millions, will be divided by 2, and it will be a portion 97.5 millions will be a portion to shareholders, and the remaining is for bondholders. Okay, the last one is alternative 3. Alternative 3 is financed using only new debt. So, for the distributions of income to bondholders, amount of debt divided by the amount of equity and times with total earnings, which is 100 million divided by 250 millions and times with 190. So the answer we get 76 million will be apportioned to bondholders, and the remaining is 114 are apportioned to shareholders.
Hi, I'm Shada. So I will explain the question C. The question is about in view of benefits and expense of debt funding. The corporation agreed to issue an additional debt 60 million, resulting a debt to equity ratio of 1.5, primarily for the purpose of increasing its capital requirement. By employing Morikaini Miller proposition, calculate the value and the overall cost of capital of the trademark October High. Okay, value of unlevered is equal to value of leverage. So VU is the total of VU is 350 million, which is amount of equity is 250 million. Then the company has raised 100 million ringgit. But for value of leverage is equity plus debt. Debt is RM 60 million. And debt to equity ratio is 1.5 that have been given in the question. So to calculate how much the additional equity, 60 million divided by 1.5, so you will get 40 million. So the total amount of equity, 250 million plus 40 million, so you will get 290 million ringgit. Value of leverage is 290 million plus 60 million, then you will get 230 million. Okay, the next one is overall cost of capital. RWACC is equal to RO. The formula of RO is EBIT divide VU. So 200 million ringgit divided by 300 million ringgit, then you will get 57.40%. Okay, that's all for me. Thank you. So I will pass to my groupmate, to Nadira Yasmin.
Hi, Assalamualaikum. I'm Nadira Yasmin binti Raza, and I will continue the last question in case study number 1, which is explain why debt level vary across sectors and within industry. The debt ratio is a financial ratio that calculates the size of company leverage. The debt ratio is defined as the ratio of total debt and total asset, expressed as a decimal or percentage ratio. It can be defined as a proportion of the asset of a business funded by debt. The higher the debt ratio, the more leverage the company, the higher the financial risk. At the same time, leverage is the valuable tools that companies use to expand, and many businesses are seeking sustainable debt uses. For various sector or industry, the nature of the company is different, as a result of which the debt demand of a company is different. The debt ratio of 30% might be too high for a business with volatile cash flow, in which the most companies have little debt. A business with a high debt ratio compared to its competitors will probably find it difficult to borrow and could find itself in a crunch if circumstances change. Contrarily, a debt level of 40% can be easily handled by a business in a sector such as telecommunications, where cash flow are stable and higher debt level are the norm.
Assalamualaikum warahmatullahi wabarakatuh. I am Izni Izzati and my friend Ainul Afika will present the answer for the case 2. Case 2 is about Randy Property Berhad is planning to invest in a project which will involve diversification into a new industry. The finance manager of the company has analyzed two types of companies, which are geared and ungeared. They are identical in every respect except for their capital structure. We are given some information such as annual profit before interest and tax, interest rate, tax rate, profit after tax, market value of equity and debt, and total market value of the company. Also stated in the question, there is no dividend growth and the beta value of the ungeared is 1.0. The first requirement of the case is to calculate the cost of equity to the equity holders in the geared company. To answer this question, we use the KE formula where KE is equal to dividend divided by current market value and plus dividend growth rate. So, since there are no growth rate in the question, we just take 510, which are the profit after tax. They are paid as dividends and divide by 3,900 as the market value. So we get the answer 13.08%. The second requirement is to calculate the beta value of geared using the asset beta formula and explain the calculated beta. To answer this question, we use the beta formula where beta equity multiple with value of equity divided by sum of value of equity plus value of debt times 1 minus tax. So we get 1.80. The beta value measures the systematic risk appropriate to a share or a project. The equity beta is the beta value that captures both business risk and financial risk. It will give the return required by an equity shareholder in a company that is geared. A company with a beta that is greater than 1 is more volatile than the market. A company with a higher beta has a greater risk and also a greater expected return. So, the beta calculated previously, which is 1.80, would have returned 180% of what the market returned. That's all from me. The next requirement, which are B and C, will be presented by Ainul Afika. Thank you.
Thank you, Izati. I will proceed for the next question. Explain the leverage effect and the implication to companies if earnings are insufficient to cover interest obligation. The leverage effect describes the effect of debt on an equity return. Additional debt can raise the owner's equity return. In this case, the leverage effect is a positive leverage effect. The company only has to pay 8% interest on the capital it obtained, but generates a total return of 30.08%, as less equity capital is required for the project is used more effectively and economically. This results in a higher return on equity. Therefore, the implication to the company if earnings are insufficient to cover interest obligation happen when the value of the asset decrease or interest rate increase to unmanageable level. Also, when increased level of financial leverage can lead to significant fluctuation in business income. As a consequence, the stock price of the company will rise and fall more often and will hinder the proper accounting of stock options held by the employee of the company. Increased stock price will mean that the company will pay shareholder returns interest. Lastly, revenue volatility can quickly drive a business into bankruptcy because it will not be able to satisfy its rising debt obligation and pay its operating expenses. And the next question for the case 2 is discuss the relationship between financial distress and capital structure and purpose the consideration to be addressed by using debt financing. If the corporation attach additional debt to its capital structure, the WACC of the company grows above the ideal amount, raising the cost of bankruptcy, financial distress. The cost of bankruptcy occurs when the company is more likely to default on its financial obligations when it has decided to raise its debt funding instead of using equity. Some factors that can be considered to use debt financing are the lender doesn't have control over the business and the agreement with the lender stops when the company pays the loan back. And the last, the interest obligation incurred is exempt from the tax. That's all from me, Ainul Afika binti Lukman Najib, and thank you for hearing our group presentation.